Meantime, Netflix shares rallying almost 10%, setting a record close after earnings last night. The stock getting within $1 of the $1,000 a share mark. It ultimately closed at $9.54. The streamer yesterday reported historic subscriber growth. One media trailblazer remains bullish on the streaming giant with some caveats. Let's bring in CNBC founder and contributor Tom Rogers. He served as NBC cable president. Tom is now executive chairman of Orbit Media and Entertainment.
I think he deserves a clap in. Tim, this doesn't happen on the other shows.
No, it doesn't deserve to either. But when you have the Godfather
Shall
here,
remain unnamed.
I'm breathless. I'm not going to be able to offer any analysis after that.
What are the caveats, though, to Netflix's success story?
Well, as you said, I've been a huge bull on Netflix, but I think taking a step back, there are probably 4 areas that I'm watching now to see if they're really going to climb the next hill. One is certainly aggregate viewership. Netflix does great engagement, average 2 hours a day per subscriber of viewing. But YouTube, Disney, NBC, Paramount, when you aggregate their streaming and their linear services, all have more aggregate viewership than Netflix. So that's a big one for them to take on. Secondly, advertising. They said that that was obviously going to be a huge priority for them this year. But just in the streaming space, Amazon, Peacock, Hulu, all have higher streaming advertising revenue than Netflix. Now, if they double their ad revenue this year as they projected, that may catapult them to the top. But another big one in a competitive arena to watch. Third, they've aced technology when it comes to algorithms that put in front of you the things that you're most likely going to watch, which has something to do with their big engagement numbers. But they're going to have to take technology to the advertising realm. That's a big issue for the linear players, too, because they have a lot more spots in linear television than they do in streaming. So to get those streaming ads more valuable, they have to be targeted to be more valuable to the advertiser. Netflix said it's bringing its streaming technology in-house in the United States. It's got to do that to enhance its programmatic advertising, its targeting, and its measurement. That's a big one that it's got to really demonstrate that it can get that much more value for its ads. And last is gaming. They really haven't done much when it comes to using gaming to acquire subs or retaining subs. They did say, and this was always intuitive to me, the gaming where they get the best engagement are the ones where there's Netflix IP in the game related to the shows. But to me, until they get those games up on the television set instead of on the phone, so you're playing them right after you're watching one of their shows and you really can continue the engagement of the viewer in a game beyond the TV show, they're not going to get there. And that's something that I think they got to put a lot of work into.
The gaming aspect seems like a lever they can pull at another time when they're sort of out of tricks. But in terms of the ad-supported tier, I get your commentary. I mean, they only launched in November of 2022. And so compared to a lot of the others, which already had the infrastructure in place in order to place ads and et cetera, bring in the inventory, it seems almost unfair to say the others have much more when more than 50% of their new users in the U.S., Canada, and U.K. are actually opting for the ad-supported tier. So they're really gaining traction on that level.
I think you're right. They got a pretty good game, but that's an area where to really demonstrate that they're the most valuable media company in the world across all realms, that advertising game has people ahead of them now, and I think they got to demonstrate that they can lead the pack.